The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Well, presumably, since you're watching our podcast, you pay some attention to the markets. And you know, depending on how closely you've paid attention, that in the recent weeks have had a high degree of volatility. And depending upon your frame of reference, well, some say, yeah, it's not that big a deal.
Right.
Well, unless it depends on what you compare it to. It's not that big a deal if you're looking at the volatility we had during the COVID shutdown, when the volatility indicator, the fear index, accelerated to new highs, which just recently were surpassed when the Japan carry trade collapsed. And an awful lot of smart people on Wall Street, as the saying goes, got caught with their shorts down. Their risk exposure was fully exposed, and they had to run to the exits to see if they could save whatever was possible in their portfolios. And you say, well, that didn't really affect me because I don't have that much money. But the hedge funds had billions of dollars, and they did take big losses. So that created a massive spike in volatility. I'm going to put the screen up here and show you what that means on a relative basis.
Right. The hedge funds really did. They got forced. To make the move. Like you said, Don, they were carrying a lot of risk that they hadn't really accounted for any other way other than, well, this will just keep going the way it's been going. And when it didn't, boy, they had to run for cover, and they had to run fast. And this is what comes from that.
So on the screen, what we have up here is we can go back and take a look at where COVID was. And we busted right through that. In my entire career, I've never seen numbers like this. And that would be true for most financial advisors. We've just never seen this kind of thing. Generally, we don't have clients who are trying to borrow money in Japan to buy assets in the U.S. on leverage in the whole process.
Right.
These are very, very high risk trades. They're also very, very profitable if you have them right. But this did unwind fairly quickly. So we're back down into an area where fear has subsided substantially. And this is an area of volatility that is pretty normal for the market. So this is a positive going forward at this point in time. Of course, the Jackson Hole meeting may have an announcement that adds fear again. That's just the way the market works.
It can always happen, and it's always important to keep in mind that it really does happen very quickly. It happens really fast, especially when the big hedge funds are involved, especially with the yen carry trade, which had been going on for decades uninterrupted, and it was very well accepted. It never was a very safe trade. There was always risk involved, but it became to be deemed very reliable because it had been so static for so long. And then it started to change at both ends. Japan was going to raise rates. We were going to cut rates. And all of a sudden, this super static, secure trade had a huge question mark put on it. And boy, they moved quickly to cover what their exposure was. And it was large.
For decades, the Bank of Japan just simply hasn't raised rates. And so the assumption was on the professional front, if you don't own this in your portfolio, you're really stupid. I mean, what
are you doing?
This is just a guaranteed way to make money until it isn't. And that's the reality of the market. And what was reflected in the S&P 500 is that we got this big decline that happened. And now that it's kind of washed out, say, well, the Bank of Japan got scared with the collapse that happened, so they've backed off. So they're not going to raise rates for anytime in the immediate future. At least that's the new assumption. So the carry trade's back on. Fear has subsided. The market's rising. The S&P 500 actually is back within about 3% of its all-time high. And as long as the Fed issues accommodating statements about next year, more rate cuts and the year beyond,
Right.
then I think
Right.
we're going to see new all-time highs. If they're not very accommodating, this will be under threat. What's interesting, however, is technology hasn't been quite as aggressive on the makeup here after these losses. And a lot of that has to do with artificial intelligence. Because along with the carry trade, we got the news that technology companies are having to spend a ton of money to remain competitive in how to process the benefits of AI, how to bring a product to market that people will see as a benefit to their life or to their business and be willing to spend money on. And there's still
Right.
a lot of doubt about whether or not that capital expenditure is going to be profitable anytime soon. And
And that's
that's
the
kept,
key. Anytime soon, they said, anytime new technology comes on board, we almost always overestimate the short-term impact, but we also almost always underestimate the longer-term impact. So it's not that AI is not going to have a profound effect. It is. Is it going to have a profound effect this quarter, which is what everyone was banking on? It ain't. And so everybody's like, whoa, 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 wait a minute now. We were supposed to become millionaires this quarter, not next quarter. And now people are talking about, well, no, but come back in 3 years and you won't recognize the place. And it's like 3 years. I don't have time for that, so I need to know what's going on next month. And so the short term probably got a little out over our skis there, probably got a little ahead of ourselves with how much of a return there was going to be and from where. But longer term, it's a given. It's going to happen. It's just like the internet revolution. It is going to change the way everything works. Just might not change it this year. So it's a timing issue.
well, when volatility happens like this, it often is a leading indicator of things yet to come.
Sure.
We basically saw a similar event in 2007 when Bear Stearns went bankrupt and the FDIC forced a marriage between Bear Stearns and J.P. Morgan. J.P. Morgan got a heck of a
Wait,
deal.
remember that? Remember that all went down over a weekend. That all went down over a weekend. They pulled everybody together on a Saturday afternoon and was like, okay, here's what's going to happen. It's like, man, how bad those books must have looked. Man, oh man, that must have been a scary time.
Well, and that was a tell that there were things going on underneath the market that were not
Right.
being made visible. And so in the back rooms of Wall Street, they were obviously at Stearns, they were trying to figure out how not to go through this mess.
Right.
But then their trades went against them, and they're kind of caught like the banks during COVID with the interest rate changes. And so we had
Yep.
three major banks collapse, and the Fed stepped in to deal with that. And we had the same kind of thing in '08, but it took a year before the market collapsed. It wasn't until October of '08, from March, I think March of '07, the market topped in July, and then it began a 30% decline in October of '08. So things like this carry trade collapsing may simply be a tell that there's other problems underlying the global economy that nobody wants to address yet. One of which may well be the fact that China, which is the second largest economy in the world,
Right.
is in deep trouble, and
Deep trouble. Yep.
big money is exiting. I mean, you got foreign investors who have been withdrawing billions of dollars from the capital markets in China. They're
Yep.
expanding their exports because their own economy cannot consume the production that they have. Their consumers are reluctant to trust the government because they were shut down for 3 years. Steel production is still going along okay, but steel consumption is falling and prices are falling. And that's not, you can't continue to run a company on falling prices. and keep production at its current level. Somebody's got to buy this stuff, and they're
Correct.
not cheap enough for buyers because right now industrial expansion, even in our country, is not big enough to consume all the capacity that's there. So we don't know what this may be a tale of, but we know that there are other warning signs that not all is well. How's that going to play out in the market? The only way you know that and how you maintain your sanity is by following your rules. You do have rules, don't you?
Everybody should have the rules. Yes.
Yeah, well, we do. That's how we run portfolios. You don't run them off your guts. You don't run them because God, I really like that company's product or that company's done so well over the last 30 years. You're simply going to ignore that it's done well but had 30% corrections along the way. And you say, well, I'm just looking at the average compound rate of return, not the correction. So as long as you don't care between now and your need for money, that a 20 or 30 or 40% correction is no big deal. I mean, just close your eyes. Don't watch the market. That's for sure.
And people try to convince themselves that that's how they're going to behave, but it never is. People do not behave that way. Just look at the hedge funds, the biggest players in the room all the time. They just all ran for the exits at the same time over the yen carry trade when that blew up. It didn't even blow up. It just got a little tighter, and it was like, nope, we're out. And they all ran for the exit at the same time. And then because while Wall Street wants you to think we're all independent thinkers here, and we all think up our own stuff. It's just a copycat. It's just a copycat business, and all of a sudden everybody's like, "What do you mean Bob sold?" Well, okay, then we're selling too. If Bob sold, we're selling. Bob and Fred both sold. Okay, we got to sell everything, and that's it. It just cascades upon itself, and that's what happened. And if you get caught up in that, and you get a few bad days in a row on the S&P because of something like that, you can't get caught up and say, well, I have to change all my investment outlook now. Everything's changed. It's like, no, it hasn't. One thing changed. A lot of money got into rotation, but it's all going to find its way back into the market. It's just a matter of where and where the winner is going to be. You already know the losers. Anybody who got caught holding the bag in the yen carry trade, they got blown out whether they wanted to or not. So you can't let emotions drive what you do. That's how you make big mistakes. Even the largest players make that mistake. Everyone gets caught up in that. That's why it's so important to have rules you can rely on, rules that you've used before. So when things get bad, you're not testing out that life preserver for the first time. He's like, okay, I've been here before. I know how this can work out, so I'm going to do it again. That gives you the best chance of being on the better side of those trade moves.
So for many people, the trade rule is just simply to be diversified. But diversification, modern portfolio theory, is a portfolio process of regrets. When the market's going up, you regret you're overly diversified. When the market's going down, when the market's going up, you regret you're overly diversified. When the market's going down, you regret that you're not more broadly diversified. So
right,
it somewhere in between, you need to have a defined investment process that you can write down, put it in front of you, and say, okay, when these things happen, this is what I do. This is what I do at the end of the week. I happen to coach some financial advisors, and my last discussion on Friday's coaching session this last week with an advisor was, what's your review process on Friday? At least at the end of the week, review every position and ask yourself, does this meet my objectives? Does it meet my criteria for having it in my portfolio? And why? Document it. You're going to sleep
correct.
better over the weekend. And if
You
the
will.
answer is it shouldn't be here, then on Monday you know what you're going to do.
That's it, Don. I don't know how many times I've heard you tell another advisor, ask them the question, because they'll be saying, well, I did this and here's where I am. What should I do? Almost always the next thing out of your mouth is, well, what do your rules say? What do your rules say? It's going to tell you where you are and what to do next. And do that. Do whatever that says. And that's your process. Use it. And that's the best way for your process to work for you. It's the only way your process can work for you.
Well, and that's where when we talk to individual investors and they ask us the question, what do I do with this? And said, well, they don't. It turns out they don't have any rules. You
Of
know,
course.
they liked the CEO. They liked the product. It
Yep.
reminds me of a couple decades back when talking about investments that we're making I was a broker at the time, and the wife would say, "Well, I don't care about anything except I want to own Nordstrom because I spend a lot of money at Nordstrom and I want some of my money back."
There you
Okay.
go.
Well, there was a time where that was a good trade, but all good things come to an end, and that's especially true in the market. And that should probably be true of our time with you here today. Thanks for watching. Sign up to subscribe to the podcast. The information's right down below. If you want to talk to us about your portfolio, we'll do a free review. We don't need to know how much money you have. Just tell us what you own. Let's talk about what you own and why, and whether or not it looks like it's still a strong position in the current market. Let us help you sleep better. Talk to us, send us an email. Either way, we'll be glad to spend some time with you. Have a great week.